Silver has long held a unique position in the global financial system because of its dual nature as both a precious metal and an industrial metal. Unlike gold, which is primarily valued for wealth preservation and investment, silver plays a critical role in modern industry while also serving as a store of value. This dual demand gives silver strong growth potential, especially in periods of economic expansion and technological advancement. However, it also makes silver significantly more volatile than gold, exposing investors to higher risks along with higher possible rewards. One of the biggest reasons silver is gaining attention in 2025 is its increasing industrial demand. Silver is an essential component in many modern technologies, particularly in renewable energy systems. Solar panels rely heavily on silver due to its excellent electrical conductivity. And as countries continue to invest in clean energy solutions, demand for silver is expected to rise steadily. Governments around the world are pushing for green energy transitions, and this shift is creating long-term structural demand for silver that did not exist at the same scale decades ago. Electric vehicles are another major driver of silver demand. EVs use significantly more silver than traditional gasoline-powered vehicles, particularly in battery management systems, charging infrastructure, and electronic components. As global adoption of electric vehicles accelerates, silver consumption is likely to increase further. This industrial usage provides strong fundamental support for silver prices and makes it an attractive investment for those who believe in long-term technological growth. Electronics manufacturing also plays a major role in silver demand. Smartphones, laptops, medical equipment, and advanced electronics all rely on silver due to its superior conductivity and reliability. As digitalization expands worldwide, the need for silver in electronics continues to grow. Unlike gold, which can often be recycled and reused easily, silver used in industrial applications is frequently lost or consumed, reducing available supply over time and potentially increasing long-term prices. Despite these strong fundamentals, silver is known for its volatility. Unlike gold, which is often stable during economic uncertainty, silver reacts sharply to market sentiment. Economic slowdowns, reduced industrial activity, or global recessions can quickly reduce demand for silver, causing prices to fall sharply. This sensitivity makes silver more unpredictable and risky in the short term. Market sentiment plays a major role in silver price movements. When investors feel optimistic about economic growth, silver prices often rise due to increased industrial demand. However, when fear enters the market, such as during financial crises, recessions, or geopolitical tensions, silver can experience sudden price drops. This is because investors often move their capital into safer assets like gold or government bonds, reducing demand for silver temporarily. Another factor contributing to silver's volatility is its smaller market size compared to gold. The silver market is less liquid, meaning fewer large transactions can significantly impact prices. This makes silver more susceptible to sharp price swings caused by speculation, institutional trading, or changes in investor sentiment. While this volatility can create opportunities for high returns, it also increases the risk of losses for unprepared investors. Inflation also plays a complex role in silver pricing. Like gold, silver is often considered a hedge against inflation because its value tends to rise when currencies lose purchasing power. However, silver's industrial nature means that inflation-driven economic slowdowns can sometimes offset this benefit. If inflation leads to reduced industrial production or weaker consumer demand, silver prices may struggle despite rising inflation. This makes silver less predictable than gold during inflationary periods. Currency movements further influence silver prices. Since silver is priced in US dollars, a stronger dollar usually puts downward pressure on silver prices, making it more expensive for international buyers. Conversely, when the dollar weakens, silver often becomes more attractive, leading to price increases. Traders closely monitor currency trends when making short-term silver investment decisions. For investors, silver's higher volatility means it is best suited for those with a higher risk tolerance. Long-term investors who believe in the growth of renewable energy, electric vehicles, and technological innovation may find silver an attractive asset due to its strong future demand. However, they must also be prepared for significant price fluctuations along the way. Unlike gold, which is often held for stability, silver requires patience and a strong understanding of market cycles. Short-term traders, on the other hand, often view silver as an opportunity for profit through price swings. Because silver reacts quickly to economic data, interest rate decisions, and global events, it offers frequent trading opportunities. However, this also means that incorrect timing or emotional decision-making can lead to losses. Successful silver trading requires careful analysis, risk management, and discipline. Another important consideration is silver's supply dynamics. Mining output can fluctuate due to labor costs, environmental regulations, and geopolitical factors. Since much of the world's silver is produced as a byproduct of mining other metals such as copper and zinc, supply is not always directly linked to silver demand. This imbalance can cause sudden shortages or surpluses, contributing to price volatility. Despite these risks, silver remains attractive because of its affordability compared to gold. Retail investors who may not be able to afford large amounts of gold can still invest in silver at a lower price point. This accessibility often increases demand during periods of economic uncertainty, especially among small investors seeking protection against inflation or currency depreciation. In the long run, silver's outlook remains strong due to its essential role in future technologies and green energy development. However, its price behavior will continue to be more volatile than gold due to its dependence on industrial demand and global economic conditions. This makes silver a high-risk, high-reward asset rather than a stable store of value. In conclusion, silver offers strong growth potential driven by expanding industrial demand, renewable energy adoption, and technological advancement. However, its dual nature also makes it more volatile than gold, with prices heavily influenced by economic cycles, market sentiment, and global demand fluctuations. Investors who understand these risks and are prepared for price swings may find silver a rewarding investment, while those seeking stability may prefer to balance silver with safer assets. Ultimately, silver is best suited for investors who can tolerate volatility and are willing to hold through market fluctuations to benefit from its long-term potential. Silver has long been considered a reliable hedge against inflation and currency devaluation, much like gold. However, what makes silver unique is its affordability and its strong connection to both investment demand and industrial use. Because of this dual nature, silver can act as a powerful wealth protection tool when used correctly. But timing plays a crucial role in determining whether an investor benefits or suffers losses. One of the main reasons investors turn to silver is its ability to preserve value during periods of inflation. When inflation rises, the purchasing power of fiat currencies decreases, meaning money buys fewer goods and services over time. Precious metals like silver tend to retain their value in such environments because they are tangible assets with limited supply. As prices of everyday goods rise, investors often shift their money into silver to protect their wealth from losing value. Silver also benefits during periods of economic uncertainty. When global markets face instability due to political tensions, financial crises, or banking problems, investors often seek safe haven assets. While gold usually receives the most attention, silver also attracts capital due to its historical role as money and store of value. This increased demand often pushes silver prices higher during uncertain times. However, unlike gold, silver is far more sensitive to market cycles. This sensitivity makes timing extremely important for investors. Silver prices can rise quickly during inflationary or growth periods, but they can also fall sharply during economic slowdowns. Because silver is widely used in industries such as electronics, solar energy, and manufacturing, its price is directly influenced by industrial activity. When economies slow down and production decreases, demand for silver can drop, pulling prices lower even if inflation remains high. This is why silver is considered both an opportunity and a risk. Investors who understand market cycles can take advantage of silver's volatility by buying during price dips and selling during rallies. Historically, silver has shown strong rebounds after major corrections, rewarding patient investors who hold for the medium to long term. However, those who enter the market at peak prices without proper planning often face losses when prices correct. Another important factor affecting silver prices is the strength of the US dollar. Since silver is priced in dollars globally, a strong dollar usually puts downward pressure on silver prices. When the dollar weakens, silver becomes cheaper for foreign buyers, increasing demand and pushing prices higher. This inverse relationship makes monitoring dollar trends essential for anyone investing in silver. Interest rates also play a key role in silver's performance. When interest rates rise, investors often move their money into interest-bearing assets, such as bonds or savings accounts, reducing demand for precious metals. Conversely, when interest rates are low or falling, silver becomes more attractive because the opportunity cost of holding it decreases. This is why silver often performs well during periods of loose monetary policy and economic stimulus. Silver's lower price compared to gold makes it more accessible to retail investors. Many people who cannot afford large quantities of gold turn to silver as an alternative way to protect their wealth. This accessibility increases demand during inflationary periods, but also contributes to volatility as retail investors tend to react emotionally to market movements. Sudden buying or selling pressure from retail investors can amplify price swings. Another factor to consider is silver's supply structure. Much of the world's silver is produced as a byproduct of mining other metals such as copper, lead, and zinc. This means silver supply does not always increase in response to higher prices. If industrial demand rises quickly while supply remains limited, prices can surge. On the other hand, if industrial activity slows, excess supply can push prices downward. For long-term investors, silver can be an excellent hedge when used as part of a diversified portfolio. Holding silver alongside assets like gold, stocks, and bonds can reduce overall portfolio risk. Silver tends to perform well during inflationary periods and economic recoveries, making it a useful balancing asset. However, it should not be relied upon as the sole investment due to its volatility. Short-term traders, on the other hand, must approach silver with caution. Because silver prices react quickly to news, interest rate changes, and global events, short-term trading requires constant monitoring and technical analysis. While profits can be significant, losses can occur just as quickly if market movements go against expectations. Successful silver trading depends heavily on discipline, timing, and risk management. In the long run, silver's outlook remains promising due to rising industrial demand, particularly in renewable energy and technology. Solar panels, electric vehicles, and electronic devices all require silver, and global demand in these sectors continues to grow. This structural demand supports the idea that silver will remain valuable over time, even though prices may fluctuate in the short term. In conclusion, silver can be a smart hedge against inflation and currency weakness, but it requires careful timing and strategic planning. Its affordability and industrial importance make it attractive, while its volatility demands caution. Investors who buy during market dips and hold for the medium to long term may benefit significantly, while short-term traders must closely watch economic indicators, dollar strength, and market trends. When used wisely, silver can play a powerful role in protecting wealth and enhancing long-term investment returns.